Have you ever wondered why some people work hard their entire lives yet still struggle with money, while others quietly build massive wealth? The secret isn't just in how much you earn, it lies in how you think and how you invest. The Intelligent Investor by Benjamin Graham, the father of value investing, has been a life-changing guide for millions. Legendary investor Warren Buffett once said, "This is by far the best book about investing ever written." He read it at just 19 and used it as the foundation for building a fortune of over $80 billion. But here's the thing. The principles in this book aren't complicated. Nor are they reserved for Wall Street insiders. They are practical, simple, and can be applied by anyone, you and me included, if we learn to approach investing the right way. In today's video, I'll share with you the 3 core principles and 5 practical lessons from the Intelligent Investor. This isn't just about money, it's about transforming your mindset. From fear of uncertainty, to confidence, discipline, and ultimately, financial freedom. So let me ask you, if you began shifting the way you see investing today, how different could your life look in 5 or 10 years? If you find this helpful, don't forget to subscribe and hit the bell icon so you won't miss future videos. Drop a comment below. I read and reply to every one of them because I want this to be a conversation, not just a monologue. This is Different Thinking, a channel where we explore fresh mindsets to live, work, and invest smarter. Stay with me until the end of this video, because sometimes a single new perspective can change the entire way you walk your financial journey. And as a special thank you, if you subscribe to Different Thinking today, I prepared a small gift for you, a free ebook titled, Analyze. Don't Speculate, The Investing Secret. You can download it right now in the description or pinned comment below. These are condensed insights you can start applying tonight. Don't miss this opportunity, because sometimes one small habit can create a completely different future. When people first think about investing, the first thing that comes to mind is profit. But the harsh truth is this: profit is not always in your control. There's a silent yet extremely dangerous enemy that every investor must face, and that enemy is inflation. Imagine this. If you have $100 today, after 10 years with an average inflation of 3% per year, your purchasing power drops to about $74. That means even if you don't spend a single dime, your money is still evaporating. This is why Benjamin Graham called inflation the #1 enemy of investors. And it's not just inflation. Financial markets are constantly moving, influenced by factors far beyond our control: government policies, technological shifts, wars, natural disasters, or even a single tweet from a famous billionaire. Stock prices swing unpredictably, sometimes in ways that make no sense. You might see a company's stock skyrocket because of a rumor, and then crash overnight due to an unexpected event. For beginners, these roller coaster movements can be discouraging and even terrifying. But Graham pointed out that volatility itself is an opportunity for those who can see further and remain calm. Instead of panicking when markets fall, the intelligent investor sees it as a chance to buy assets at a discount. And instead of getting euphoric when markets soar, they remain cautious and disciplined, resisting the urge to chase temporary hype. I remember in 2020, when the US stock market plunged due to the pandemic, countless people panic sold, yet a small group, patient and steady, bought more shares of top companies. Just 2 years later, their portfolios had doubled, while those who panicked missed a golden opportunity. Investing, therefore, is not a game of emotions, it's a test of mindset. You can choose to be a victim of inflation and volatility, or you can learn to make them your allies. That choice is the first step to becoming an intelligent investor. So here's a question for you. When was the last time fear of the market changed your financial decision? And if you could go back to that moment, what would you do differently? One of the most common mistakes new investors make is jumping into the market based purely on rumors or short-term predictions. They hear friends say, "This stock is about to skyrocket," or they read somewhere that that company is launching a new product soon. Without much thought, they throw in their money, hoping for quick profits. But Benjamin Graham called this speculation, and speculation is nothing more than gambling. Sure, you might win once, but over the long run, the odds are almost always stacked against you. Intelligent investing isn't about chasing news, it's about analysis. Analysis means you take the time to dig deep into a business, what they do, how profitable they are, how much debt they carry, whether their leadership is trustworthy, and whether the company has potential to grow for years to come. Imagine you're considering buying stock in a phone manufacturer. If you jump in just because you heard they're releasing a new model, that's speculation. But if you review their financial statements, notice a history of stable profits, strong leadership, and products that customers genuinely love, that's analysis. A familiar example. Many people bought Apple stock just because of rumors like, the next product will be a massive hit. Some made money, but many lost when the product didn't meet expectations. In contrast, the intelligent investor doesn't chase headlines. They look at Apple's financial strength, its product ecosystem, its customer loyalty, and those are the real long-term reasons to own Apple stock. Analysis also helps you wait patiently. A stock may be fantastic, but if the price is far above its true value, buying it is still a mistake. The intelligent investor is willing to wait until the stock trades below its intrinsic value, like buying something on sale rather than overpaying. You might ask, doesn't this take too much time? Can I really do it? The answer is, you don't need to be a Wall Street expert. All you need is to learn how to read a few basic metrics. And more importantly, develop the habit of thinking long-term rather than reacting emotionally. That alone puts you ahead of most investors out there. Speculation is the game of emotions. Analysis is the work of reason. And in investing, it's reason, not emotion, that becomes your weapon for survival and success. So here's a question for you. The next time someone whispers that a stock is about to explode, how will you respond? Will you rush in with the crowd, or pause, analyze, and choose the path of the intelligent investor? When it comes to investing, one of the biggest mistakes people make is trying to time the market. They wait for the perfect moment to buy, or they sell the second they see volatility. But here's the truth. No one can predict the market with accuracy. Even seasoned experts get it wrong, often. This is why Benjamin Graham recommended using the strategy of dollar cost averaging, DCA. It sounds simple, yet it's incredibly powerful. Instead of putting in a large lump sum at once, you spread your investments out, monthly or quarterly, regardless of whether the market is up or down. What's the benefit? When prices are low, the same amount of money buys you more shares. When prices are high, you buy fewer. Over time, you create an average purchase price, reducing the risk of buying at the top, or missing out trying to catch the bottom. Imagine this. You invest $500 every month into an S&P 500 index fund. In a down year, you might feel nervous, but during that time, you're actually buying more shares at cheaper prices. And when the market recovers, your portfolio grows faster because you've already accumulated plenty of low-cost shares. A friend of mine has followed this strategy for 15 years. Through the 2008 crisis and the 2020 pandemic crash, he kept investing into index funds every month. The result? His portfolio not only stayed safe, but grew steadily, far outperforming those who constantly tried to find the right moment. Dollar cost averaging isn't a get-rich-quick scheme. It's the slow, steady path. But here's the key. Most wealthy, disciplined, and resilient investors take this path because they understand time in the market is far more important than timing the market. So here's a question for you. Do you want to be the person constantly stressed out trying to guess the market? Or the patient investor who steadily plants seeds and lets time do the work? When it comes to investing, one of the biggest mistakes people make is trying to time the market. They wait for the perfect moment to buy, or they sell the second they see volatility. But here's the truth. No one can predict the market with accuracy. Even seasoned experts get it wrong, often. This is why Benjamin Graham recommended using the strategy of dollar cost averaging, DCA. It sounds simple, yet it's incredibly powerful. Instead of putting in a large lump sum at once, you spread your investments out, monthly or quarterly, regardless of whether the market is up or down. What's the benefit? When prices are low, the same amount of money buys you more shares. When prices are high, you buy fewer. Over time, you create an average purchase price, reducing the risk of buying at the top, or missing out trying to catch the bottom. Imagine this. You invest $500 every month into an S&P 500 index fund. In a down year, you might feel nervous, but during that time, you're actually buying more shares at cheaper prices. And when the market recovers, your portfolio grows faster because you've already accumulated plenty of low-cost shares. A friend of mine has followed this strategy for 15 years, through the 2008 crisis and the 2020 pandemic crash. He kept investing into index funds every month. The result? His portfolio not only stayed safe, but grew steadily, far outperforming those who constantly tried to find the right moment. Dollar cost averaging isn't a get-rich-quick scheme. It's the slow, steady path. But here's the key: most wealthy, disciplined, and resilient investors take this path because they understand time in the market is far more important than timing the market. So here's a question for you. Do you want to be the person constantly stressed out trying to guess the market? Or the patient investor who steadily plants seeds and lets time do the work? We live in a world that constantly pushes us to hurry up. People want to get rich fast, succeed fast, even hope to become millionaires overnight. But Benjamin Graham reminds us, intelligent investing is never a sprint, it's always a marathon. The third principle is, don't chase massive profits in one shot, focus instead on steady, safe returns. Warren Buffett, Graham's most successful student, once said, "Rule number 1, never lose money. Rule number 2, never forget rule number 1." That sounds simple, but in reality, it's incredibly difficult. Human instinct pulls us toward greed when the market rises, and panic when it falls. The intelligent investor understands they don't need to win every battle. They just need to survive long enough to win the war. Look at how Warren Buffett invests. He doesn't chase risky bets hoping for luck. Instead, he buys strong companies with sustainable competitive advantages, and holds them for decades. The result? Steady returns, compounded over time, turning him into one of the wealthiest people on earth. Here's an interesting story. If you invested $10 in the S&P 500 in 1990 and just left it alone, today you'd have over $200. But if you let fear push you out and missed just the 10 best days in those 30 years, your returns would be cut almost in half. That's the power of patience. Graham also advised, don't try to beat Wall Street. There are professionals who dedicate their lives to reading the market. We don't need to, and we shouldn't try to compete with them. Our goal is to build a portfolio that serves our lives, not to prove we're smarter than everyone else. Intelligent investing is like planting a tree. You can't rush it to grow overnight. You plant the seed, nurture it, water it, and patiently let time do its work. And one day, when you look back, you'll see a lush garden born out of your persistence. A question for you. Do you want to be the person constantly chasing temporary waves? Or the one patiently planting seeds to harvest lasting fruit? After the 3 major principles, Benjamin Graham left behind 5 highly practical lessons for everyday investors. These are guiding lights to keep you from losing your way in a market full of traps. First, don't day trade. It sounds tempting, buying and selling constantly to grab quick profits. But in reality, day trading requires iron discipline, deep knowledge, and a high tolerance for risk. For most investors, it's the fastest way to lose money. Second, be cautious with IPOs. Many believe buying shares at a company's first public offering is a golden opportunity. In truth, IPOs are often overpriced. Early buyers often pay too much, while the company's real value hasn't been proven. Third, buy stocks below intrinsic value. Simple in theory, harder in practice. When a good company faces temporary trouble, or when the market crashes, that's often the chance to buy at a discount. In other words, buy when others panic, and patiently wait for true value to show. Fourth, index funds are your best friend. For most everyday investors, index funds provide 3 big advantages: low fees, automatic diversification, and passive management, meaning you don't have to babysit your portfolio. Over the long run, most index funds even outperform professionals. Fifth, always maintain a margin of safety. This is the gap between the market price you pay and the true value of the asset. A margin of safety is like a seatbelt in a car. You might not need it often, but when a crash happens, it can save your life. I once knew someone who invested only in a few hot stocks, constantly trying to ride the waves. 5 years later, his account was nearly back to zero. Meanwhile, another person, far from fancy, simply bought index funds and patiently accumulated. After 5 years, he wasn't rich overnight, but his portfolio was safe and steadily growing. These lessons may sound simple, but simplicity itself is the strength. In a world where everyone tries to complicate things, sticking to the basics is what helps you survive, and ultimately win. A question for you. Out of these 5 lessons, which do you find hardest to apply in your own life? And if you had to start today, which one would you practice first? If I had to choose the single most important factor that determines success in investing, it wouldn't be financial knowledge or the ability to crunch numbers. It would be psychology and long-term thinking. The reason is simple. The market isn't just numbers, it's a mirror of human emotions, greed and fear. When prices rise, the crowd rushes in out of fear of missing out. When prices fall, they panic sell to avoid losing more. And it's these emotions, not lack of knowledge, that cause most investors to fail. Benjamin Graham taught that an intelligent investor must learn to control themselves. Not the market, because the market is uncontrollable. But psychology, emotions, and patience, those are things you can train and master. Remember the classic story of Mr. Market that Graham shared? Imagine you have a friend named Mr. Market. Every day, he knocks on your door and offers to buy or sell stocks. Some days he's wildly optimistic and offers high prices. Other days he's pessimistic and offers low prices. Your job is not to follow his mood swings but to recognize the right times, buy when it's cheap, hold when value remains. Long-term thinking is the weapon that helps you outlast short-term volatility. The impatient investor always wants results immediately, and therefore often makes poor decisions. The patient investor understands that the greatest returns don't come in a day or even a year, but from the power of compounding over time. A clear example. Albert Einstein once called compound interest the 8th wonder of the world. Those who understand it, earn it. Those who don't, pay it. Long-term thinking allows you to let compounding work in your favor, instead of constantly interrupting it with fear. I once met an ordinary investor, not brilliant, not a master analyst, but he had one remarkable strength: patience. For 20 years, he steadily invested in index funds, never flinching when the market rose or fell. Today, he has the financial freedom many dream of, not because of luck, but because of discipline and long-term vision. A question for you. Are you letting the market's fear and greed control you? Or have you learned to make time, discipline, and patience your allies? Looking back, we can see that intelligent investing isn't about complicated tricks or some hidden secret that only Wall Street knows. It's much simpler, but it demands discipline, clarity, and patience. The 3 core principles: analyzing instead of speculating, diversifying to protect yourself, and being patient with steady returns, combined with the 5 practical lessons, form a roadmap for anyone seeking sustainable investing. The market will always fluctuate. Inflation will always be a threat. And human emotions will always be the toughest challenge. But if you learn to turn these forces into allies, investing stops being a worry and becomes a tool to build freedom and financial peace. So here's my final question for you. Which principle will you start applying today? Leave a comment to share your thoughts, because your answer might inspire someone else. If you found this video helpful, make sure to subscribe to Different Thinking today. As a thank you, I prepared a small gift for you, a free ebook titled, Analyze. Don't Speculate, The Investing Secret. You can download it in the description or pinned comment below. And don't forget, hit subscribe plus the bell icon so you won't miss future videos. The full playlist is also linked in the description. Start your journey of transforming financial thinking today.